We welcome everybody to the webinar, which is titled Understanding Foreign Currency and Reducing Risk. Today's webinar is sponsored by Scarbrough. Scarbrough University was founded in 2006 with a mission to provide necessary, relevant, and continuing education to Scarbrough employees, clients, and professionals engaged in international and domestic trade and logistics. My name is Kevin Ekstrand. I am a licensed customs broker and certified customs specialist, and I have the privilege of being the Vice President of Sales and Marketing for Scarbrough International. It's an honor to be with you today. This is an interactive webinar. We are here to answer your questions, so please submit questions. You will find the Q&A button at the top of your screen. Your questions will appear for the audience to see, so you may choose to show your name or be anonymous. I ask that you start submitting your questions right now. Please also note that you can easily adjust your windows. Please click on the top of the video portion to maximize or minimize this piece of the webinar. So while you are adjusting your screens and posting your questions, I'll take a minute to introduce you to Scarbrough. Scarbrough is a full-service logistics company that has been operating for over 31 years. We are headquartered in the heart of America, Kansas City, where faith, family, and hard work make for a great organization. We also have offices in Chicago, St. Louis, Des Moines, New York, Dallas, Laredo, Texas, Nuevo Laredo, Mexico, and Shanghai, China. Beyond our own offices, we are part of an agent network of companies that puts us in every single country around the world. Where we can take care of your needs. We are truly a great partner to our clients. We collaborate, stand by their side, and actively participate in the growth opportunities by helping them navigate import and export regulation around the world. We value each and every partnership along with each and every relationship we build along the way. As always, I would like to thank each of you for being here today. To our many clients on the call today, thank you for your partnership. If you are not yet a Scarbrough client, we welcome an opportunity to earn your trust and partnership. Scarbrough also values our numerous partnerships with government, the media, industry associations, universities, colleges, nonprofits, and for-profit businesses. Being a leader in international trade requires these strong relationships, and today we get to feature another one of our partners in Bannockburn Global Forex LLC. Bannockburn Global Forex LLC is a boutique capital markets trading firm specializing in currency, advisory, and payment services. Our firm is, and they describe themselves as, our firm is purely client-oriented, and our basic model is to combine expert counsel and pre-trade analytics with low-cost execution. And they do a great job at that. I've been working with them for a couple of years now. Their mission is to be the most trusted foreign exchange partner in the market today. And with that, I would like to introduce you to our presenter from Bannockburn today, Mr. Robert Bradley, Bob Bradley. He is a partner with Bannockburn. He is in charge of foreign exchange trading and research. Mr. Bradley graduated from St. Bonaventure University in 1980 with a degree in business administration and with a focus on economics and finance. His first job after graduating was at Barclays Bank International on Wall Street, where he was the bank office of foreign exchange and money markets trading area. This position was his first and what would become a nearly 30-year career in foreign exchange. Mr. Bradley then moved to SE Banken, also in Manhattan, where he was initially involved in managing the foreign exchange bank or back office before moving on to a position on the foreign exchange trading desk itself. Mr. Bradley held various roles over his 11 years at SE, beginning with position clerk, junior spot trader for Forex and money markets, chief spot dealer for foreign exchange, and finally a role in global derivatives sales. In 1996, Mr. Bradley moved to Cincinnati, Ohio to become a director of foreign exchange with 5-3 Bank Corp, where he was initially involved in sales and marketing before moving into management role in trading and risk management. Bob has been with Bannockburn from its inception in 2009, works in the foreign exchange trading and research area, and he currently resides in Cincinnati, Ohio with his wife Cindy, and there's 2 children. And so we're very thankful to have Bob as a presenter today, and I would like to go ahead and turn it over to Bob to start our presentation today.
Hi, everybody. Can you hear me?
We can.
Okay, great. Thanks, Kevin, for the introduction. And we've got a number of slides we can walk through. And just in preparation for that, I just like to give you a few words of introduction along with what Kevin was saying. We are client focused here at Bannockburn, and our sole product is foreign exchange. So we are actively working with clients to understand their foreign exchange needs, and then directing and advising them in terms of the products that they can use to manage any type of foreign exchange risk that they have. So with that, we'll kind of walk through the slides and keep the questions going. I think we've got quite a bit of time at the end to direct answers to any questions that you have. Next slide, Kevin.
Okay.
This is the beginning here. Foreign exchange, I believe, is the largest trading market. 7 trillion number is on the screen there. Obviously, some days are going to be higher than others, but the message here is that with the world the way it is now, where payments and funds move quickly, goods and services move quickly as well. The movement of currencies is substantial and growing. So you'll often hear the world is becoming a smaller place, and places that were not really involved in foreign exchange or global finance suddenly are. And we'll go through a number of examples of how different types of companies utilize the foreign exchange market. Next slide, Kev.
Okay.
Now here, I thought to run through a couple of examples. You'll see a lot of different types of companies that are involved in utilizing foreign exchange. And then what I thought to do is talk about one of my clients here in the Northern Ohio area is a importer of product from Germany, which they in turn sell here domestically in the U.S. Now, it's a typical situation that we're involved with, where the company has U.S. dollar receivable, but a foreign currency payable. And the currency we're talking about here is euro. And for them, it's a substantial amount of their product sales. They're buying them from Germany, and they are looking to protect that foreign exchange risk, basically the dollar exchange rate versus the euro. The way they manage this risk is they enter into a number of, we'll talk about this more, forward contracts, where they know they'll have a certain amount of invoices to pay in euro, and they'll look for opportunities where the rate is favorable, and then lock into a forward contract out 1 month, out as long as 1 year, in order to lock in the financing need, the dollar cost of that euro payable that they'll have. And they do this throughout the year. It's an ongoing hedge for them. I just visited them recently. We talked about the likelihood of the euro going lower, which would be to their advantage, and likewise the risk of the euro going higher, which would be to their disadvantage. So oftentimes there's no golden answer in terms of how best to manage foreign exchange risk, but this company is very comfortable in looking for opportunities to buy euros at a low rate to lock in their need, and they have a period of time in order to do so. Now, the second example there is an exporter who receives foreign currency. So unlike the foreign currency payable for the first one, this is a foreign currency receivable. I've got another client here closer to the Cincinnati area that falls into this category. It is a software type company, and they sell product overseas in both Europe and Asia as well. And they look to then manage this foreign currency receivable and lock in the dollars as soon as they know that they're going to be receiving the foreign currency. So thus they know what foreign amount is going to translate to in US dollars. So again, we've seen instances where this company will hedge forward a receivable that they know is coming in 1 month or 2 months or 3 months. They can lock into that foreign exchange rate now and thus know the US dollar receivable that they're going to get. So again, this is a smaller company, you know, here in Ohio, protecting their foreign currency receivable. Now, there's a number of other instances there. I'm not going to run through them all, but what I will talk about is, you know, even companies here in the US that typically view themselves as doing dollars only. And I did a seminar here in Cincinnati a few weeks ago, and most of the companies, Cincinnati related, were selling product into Europe, and they were doing so as US dollars. Now, the issue that they had is that the customers in Europe were complaining as the US dollar was strengthening. So here is an example where their customers are selling product in Europe in euros as an example, and their customers then have this payable in US dollars. As the euro weakened, the receivable wasn't worth as much in US dollar terms, and their customers were complaining about the high cost of buying the product from this US supplier. So this again is US company thinking that they've eliminated foreign exchange risk by dealing in US dollars only, but finding them involved in currency matters because their clients are involved in currency transactions. And we hear this a lot, especially, you know, in this situation as the world grows smaller, there's often competitors in local currencies, and suddenly the US dollar becomes expensive overseas for companies to buy. So again, dollar companies involved in currencies, even if they don't intend to be. Next slide, Kevin. Now, when people think about how to manage foreign exchange risk, it often becomes a question of, well, what's going to happen with these currency rates? And what I talk about here is if anybody knew for certain if a currency was going to strengthen or weaken versus another currency, we'd be on the beach somewhere drinking exotic drinks, because there is no certainty in terms of foreign exchange. And what I'll often talk about as well is it seems to be more of an art rather than a science in terms of predicting foreign exchange movements. Now, on this slide, you see a number of different factors that can contribute to movement in terms of foreign exchange rates. And what's happening with a lot of these is they are playing amongst themselves. So, you know, one could, you know, influence the foreign exchange rate one way, and another factor could influence in a different way. So it's hard to gauge what's the most important factor versus what might not be an important factor. And one of the areas that I think is difficult to understand is the market's expectation of where foreign exchange rates are going versus the reality of where they actually do go. And this becomes impactful because the position of the marketplace often dictates where the next foreign exchange movement is. And I'll liken it to a situation where if everybody believes that the US dollar is going to strengthen, most companies globally have taken positions and utilized the different products available to hedge what they expect to be a stronger US dollar. Now, oftentimes this creates a very difficult situation should the opposite occur. So if people are positioned for a stronger US dollar and suddenly the opposite happens, then you can get a rather extreme movement. And a lot of times we talk about extreme movements in percentage type terms. And often that's the most valuable usage to think about, because often what companies are really trying to do in terms of foreign exchange is protect their margin. So companies build their product and their evaluation and their financial statements on a specific, although moving, margin. Some companies might have a 50% natural margin in their business. Some companies might have 100% margin, some much less. Now, oftentimes, if it is a number, say as an example, a 20% margin, and suddenly we see a 10% movement in terms of foreign exchange that might be, adverse to them, suddenly your margin goes from 20%, which you expected, and now you've lost 10% of that margin in terms of a foreign exchange movement. So companies are, trying to protect that margin at its core, and thus this foreign exchange, management becomes impactful. Now, some of those other, bullet points on the screen there, I'll just highlight a couple of them. The interest rate differential between countries impacts currency markets, especially in today's environment where the expectation of the interest rate differential in favor of US dollars is expected to widen. The Federal Reserve is viewed as in an interest rate rising type of scenario, albeit very slowly, where at the same time you've got several other countries that are still looking to lower interest rates and expand economic growth. So this differential is expected to widen, and is one of the reasons why the US dollar in general terms has been appreciating versus a number of different currencies. I think the next slide, Kevin.
Okay.
Here is an example. It's a bit dated, but here you'll see the movement of one currency versus another, and this is based on a central bank policy decision, and it's going back to 2014. So again, a bit dated, but an example of how the exchange rate is trading for the euro around 131.25, and after an unexpected move by the European Central Bank, suddenly we find the value of the euro about 1.4% lower. So an example of a quick adjustment in terms of the market, and it's something where might be exaggerated because of the unexpected nature of the European Central Bank movement. Next slide, Kevin. This is another example. Some of the numbers are a little bit hard to see on the slide, but it's dollar yen this time, and we're looking at, again, 2011, where suddenly the exchange rate for the dollar moved down 4.65%, and then up roughly 8%, and then down 6.3% in a relatively short period of time. So again, it's a situation where markets have an ability to move and move rather quickly. Now, the next slide puts this into context. Here, you look back at the circled area, which is what we were just looking at the prior slide. So when you see that movement in a longer-term 5-year graph, the movement doesn't look that spectacular, especially when you're looking at an overall movement of from about 80 in the dollar yen all the way up to 119.97. So this is a dramatic longer term increase in the value of the dollar. Now, just to speak quickly about the yen versus the dollar, this movement in this 5-year period is reflective of an aggressive movement by the central bank in Japan and the government in Japan to raise economic growth and raise inflation. Now, as some of you may know, Japan has been fighting a deflationary environment for decades. And a deflation environment is one in which inflation doesn't rise, it moves lower. And it's very difficult in terms of economic growth in a scenario where you could buy something today, but with deflation, it would be less expensive tomorrow. So this is very detrimental to economic growth and is something the Prime Minister Abe, upon gaining control of the government, very much tried to put a policy in place, or I should say policy in place to bring about stronger economic growth and to defeat inflation and to achieve their 2% inflation target. Now, along with that, that led to a rapid, weakening of the Japanese yen across the currency spectrum, not just against the US dollar, but a drastic movement in terms of currency valuation. Next slide, Kevin. This one is, again, a little bit dated, 2013, 2014, and it's the Russian ruble. And here you've got a political situation with Ukraine and Crimea. And along with that, you've got a lowering of the price of oil and several other factors that have led to a rather dramatic weakening in terms of the Russian ruble. And here, we're talking about multiple percents. So again, the focus comes back to companies with an exposure in the Russian ruble needing to look to some type of protection in order to manage their margin. Next slide, Kevin. Now, this slide talks about the current debate about what's most important in terms of directing, the currency markets. And in the environment we find ourselves currently, often the central bank is viewed as the primary driver of currency value. Not the sole driver, but perhaps the primary driver. And what I would talk about here is this idea that the central banks have begun and continue to manage trying to grow the economies and then boost inflation. So situations where we've got negative interest rates in a number of different countries and extremely low interest rates in just about all global countries leads us to this idea that central banks are playing a primary role. Now, as I mentioned before, the Fed is viewed as moving interest rates higher as the U.S. economy seems to be improving, albeit very slowly. Likewise, at the same time, you've got a number of other central banks, Japan particularly, Switzerland, another one, and the European Central Bank, all driving interest rates to all-time lows. Now, this situation that we find ourselves in is by no means a normal situation. Anytime somebody's talking about negative interest rates is unusual, to say the least. Now, recently we seem to get into this situation where perhaps the level of interest rates has begun to stabilize. Basically, I'm hinting that the central banks might not be lowering interest rates any longer, and we could see, not only in the U.S., but in other countries as well, perhaps a gradual extremely gradual move to a higher interest rate environment. But at the same time, we might be a long ways to recovering any type of normal type of situation. Now, as Kevin mentioned, I've been in this business for a long time, and a normal type interest rate, in my view for the U.S. is somewhere between 3% and 6% for the Fed funds. Currently, we're at 50 basis points, so 0.5%. So there's nothing normal about that. However, coming out of a severe economic crisis, 2008, 2009, perhaps this extremely low interest rate environment will be here to stay as we work through the ramifications, long-term ramifications of the economic environment from 08 and 09. The last thing I'll mention here on this slide is the Brexit. That's a situation where on June 23rd, the UK decided to, via referendum, move away from the EU. And that's a significant occurrence. And, we're still seeing ramifications of that now, but it quickly led to about a 13% decline in the value of the British pound. Next up, Kevin. So here we've got more of a current type of situation, Euro trend, Canadian, crude, and the Mexican peso. Now, when you look at this graph, it looks like the euro is kind of caught between 110 and 115 currently, and the Canadian dollar right around 130, give or take. We get to 133, and then we move down to 128. The dollar versus the Mexican looks like it's on an uptrend. Part of that is due to the weakening of the oil price that we had seen, and then kind of the sideways trade in terms of oil. Next slide, Kevin. So here, we talked about a number of situations where the movement of foreign exchange rates can be dramatic. And then the question becomes, what can I do to protect my margin in these types of unusual financial conditions globally? Next slide, Kevin. So hedging is a way that we talk about, as I mentioned at the start, the company in Northern Ohio, they have a foreign currency payable in euro, and they manage it by doing forward contracts. Now, forward contracts can be customized to whatever amount, whatever period that one needs. And I also like to say that it's not etching it into stone. So if you do a forward contract today for a 6-month forward settlement, and suddenly, tomorrow you find out that you're going to need them earlier, maybe 3 months down the road, you can adjust your forward contract accordingly. So again, it's not etching it into stone, and it's giving you a flexible way to manage your foreign exchange risk today so that you know what your payable cost is going to be in dollar terms, or conversely, what your receivable in foreign currency terms will be worth in US dollars.